All right, let's turn to investment strategy and take a look at two reopening contenders to watch as economies do reopen. Marcus Bogdan joining us from Blackmore Capital in Melbourne. Marcus, good morning. Good to have a chat. Okay, well, we're assuming, of course, that we're believing in the reopening and it's all still on course at the moment. Some question marks, I guess, being exhibited by investors at the moment, given where we're at with those markets, what's going on in Europe, rollout of the vaccine. How are you looking at it?
Well, the reopening is definitely uneven around the world, but we've been sort of driven certainly by what's happening in the US and in Australia, and the earnings profile for both of those jurisdictions is incredibly strong. In Australia, expectations of 15% plus EPS growth for 2021. If you go out to the end of December, it's over 20% in both the US and in Australia. So all of that is encouraging, but all of that definitely shapes where we want to be positioned at a portfolio level.
What do you make of the phenomenon that we've seen over the past few sessions where we see yields very calm in the United States, but also seeing pressure on the NASDAQ? Do you think that speaks to a questioning of this rotation, or do you think that it also perhaps reflects a little bit more reticence on behalf of retail investors?
Well, I would certainly look at it in the lens of bond yields, and bond yields are rising, and this is a natural phenomenon as economies start to grow. So in that sense, it is a good thing, but it does have a material impact on the factors or the sectors that you're exposed at a portfolio level. The growth stocks, the technology stocks, as you refer to, have done incredibly well since the GFC, based on very low bond yields. Now we're starting to see a rotation away from that, and we still think that that's got further to go. So we have got a bias to quality and a bias to value over growth or bond-like equities at this point in time.
Okay, so further evidence of that reopening, of course, is you just have to take a look at the oil price, where that's gone. Has come off of late, but then, of course, we just had this blockage in the Suez, so that's putting upward pressure on it yet again. So locally, obviously, Australians have hit the road. That's positive, just as far as looking stock specifically, Ampol is concerned.
Yeah, sure. So we are looking at those stocks in the recovery phase, and there've been some really good first movers in commodities and in banks. But now we're turning our attention to those companies that have really lagged, and one of those has been Ampol, and there's been some idiosyncratic reasons for that. It was a pretty benign result. They've been obviously impacted greatly by the pandemic, not only on consumer driving, on commercial demand for fuel and for jet fuel. But as we start to reopen, we're already seeing consumers coming back. The demand for diesel is coming back, and ultimately jet fuel will start to normalize as well. And then you've had pressure on refiner margins. So we think Ampol and refining is at the bottom end of the cycle, and hopefully now we can start to see some recovery, and it's definitely reflected in the low valuation of that stock at the moment on an EBITDA multiple of around 6.5 times. We think that can normalize to about 8 times through the cycle. And the other big issue with Ampol is whether the one refinery that they've still got open, Lytton, whether they will decide to bring that back to an import terminal, which will be good from a company-specific basis in terms of it will improve returns, it will improve the ability for further capital management. They've got $650 million of franking credits on the balance sheet. So net, we think that would be a positive, and the company suggested that they will make a decision by June on Lytton.
Well, and I suppose with Ampol, you have to take into consideration the retail operations and also the Australian dollar, which is more favourable when it is coming under a bit of pressure as it is right now. Ramsay Healthcare is on your list of companies that are looking pretty good in terms of this reopening. How has it negotiated the pandemic, and why is this a reopening thematic?
It's unusual that healthcare are one's recovery plays, because historically they're defensive, but the pandemic by its very nature has impacted particularly healthcare stocks and elective surgery. In Australia, which is the bulk of Ramsay's earnings, you are now starting to see a very sharp recovery in elective surgery volumes, running at sort of 1.5 times normalised levels. And then where you're going to see further expansion is in the non-surgical area, the medical, the psychiatry area as well, and also a better mix of volumes as more surgical volumes start to come on. You're starting to see some moderation there on the cost side in PPE. So that's Australia. They're also exposed to the Northern Hemisphere, particularly in the UK and Europe, and that is at the moment a tale of two cities. The UK is well ahead on the vaccine rollout, and now you're starting to see hospitalisation rates fall. You'll see the resumption of elective surgery. Ramsay have entered into contracts with the NHS to do some of the backlog work in the public system, which is incredibly important. Europe, France in particular, remains challenging, but Ramsay is at the low end of its 5-year valuation, and we expect that recovery will be sustained, and then that valuation will improve over time.
All right, Marcus, good one. Thanks for joining us from Blackmore Capital. The two ones to look at there, Ampol and Ramsay Healthcare. Thanks very much.
Thanks, Andrew and Nadine. Cheers.
Thank you.